All right, guys, hello and welcome. In this particular video, I want to talk to you about one of the biggest lies and mistakes that people believe in about the markets. It's a lie and a mistake that I would say the majority, 99% of people out there, including financial news media, believe in. And I want to explain to you, with the help of Bob Prechter here, analyst and financial author, what this particular mistake is and what we can do about it. All right, guys, join us. Okay, welcome back. The question I want to ask Bob in this particular video is this. A lot of people think that price action and market movements in the stock markets, in Bitcoin, whatever market, that they're caused by the news and fundamentals like the Federal Reserve, things like that. But is that correct? Do news and the Federal Reserve actually move markets? For example, is it true that the Federal Reserve actually makes the market bottom, like most people believe? How likely is that? And why is that view wrong? In fact, I think that view is wrong, and I want to ask Bob Prechter about that view. Bob, thanks very much indeed for joining us. How are you, by the way? You well?
Yeah, doing fine.
Thanks very much. So this actually is what really fascinates me. And I read about it. First of all, you talk about it in great detail in your book, The Socioeconomic Theory of Finance. You also talk about it in your book, Conquer the Crash, both books which I highly recommend you get, guys, and check out the link in the description for a great discount on that. So a lot of people believe in this conception, this idea, Bob, that news and fundamentals is what causes the market to move. Every time I publish a video, I get this comment from people, oh, the news did it. So-and-so did this, the president did this, the market did this, therefore the market bottomed or the market rallied. It seems that most financial news media and the majority of people out there have this dogmatic belief, which is not their fault, they just acquired it from other people, which the idea is something you call mechanism, the idea that news and fundamentals is what drives the price action, what drives the market or causes the stock market movement. Before you give your answer, Bob, I hope you don't mind, but I want to show you some examples of what I'm talking about. I have some charts, and I apologize to everyone keeping Bob waiting for this while I just show these examples. Okay, here's a good example. People often say, oh, the Federal Reserve will jump in and save the market. Well, if we just have a look at history, we see during 2008, in the 2008 market crash, despite every attempt by the Federal Reserve and the government to try and save it, we can see all those arrows, those blue things, show every time the government and the Federal Reserve intervened. Guess what? The market ignored it and dropped and crashed by 50% during that whole period. We can see the drawdown of 50%. Okay, so that view failed dramatically. That view that the Federal Reserve comes in and saves the market completely failed in 2008. But more recently, in 2020, this is a beautiful example, which is that everybody said that the reason why the stock market bottomed in the year 2020, on March 23rd, the bottom there, was because the Federal Reserve intervened and magically saved the day. What they forget, though, is the Federal Reserve actually intervened twice before March 23rd, as we can see on March 3rd and on March 15th. Both times in March, the Federal Reserve intervened. They made all kinds of stimulus measures. It didn't matter. It didn't make a single bit of difference because the stock market continued to crash, as we see here. But 34%, the thing is that most people only remember the last day, the March 23rd, not the previous two, as we can see here. And by the way, just to prove this point, this is the headline of the New York Times on March the 3rd, 2020, first time the Federal Reserve intervened. Look at the headline. Fed makes emergency rate cut, but markets continue tumbling. This is the news with CBS News. This came on March 16th, and what I'll do is I'll edit this into the video. I'll put a clip for you guys to watch it.
This is a CBS News special report. I'm Anthony Mason in New York, where stocks on Wall Street plummeted again this morning. The Dow Jones Industrials fell more than 9%, almost 10%, which means trading was automatically stopped for 15 minutes. This follows the Federal Reserve's surprise decision yesterday to slash interest rates to nearly 0%. in an effort to limit economic damage. Weijia Zhang is at the White House, where President Trump praised the Fed move yesterday.
This is absolutely crushing for the economy. There is no other way to put it. And it's exactly what President Trump did not want and did not expect, Anthony, because as you mentioned, the Fed cut its benchmark rate yesterday by a full percentage point to now the range of 0 to 0.25%. And the markets should be thrilled. And of course, we have just seen that is not what has happened at all.
Jill, are you surprised by the sharpness of this drop?
The Federal Reserve has done exactly what it is supposed to do. What the Federal Reserve cannot do is stop the negative consequences. We have now slammed on the brakes, and we are in a wild skid. We don't know where we end up.
They were astonished. They couldn't believe the market crashed and tanked by nearly 10%, despite the fact the Federal Reserve had intervened just the day before, on March 15th, with all kinds of stimulus measures. They couldn't believe it. They thought the market could not possibly drop, but it did. Bob, thank you so much for being patient for that. But what do you think about that? Because you call this in your book, you call this the potent director assumption, that these powerful directors are in control, the Federal Reserve, the government, and they can just do whatever they want. And anyway, I've done enough talking. You go ahead, Bob. What do you think about that?
So I love your charts.
Thank you.
They exactly show that what is in people's heads about the news causality is completely wrong. But the reason that they have difficulty getting out of that mindset is that the mechanistic understanding in the human brain, which goes all the way back tens of thousands of years, is there for a good reason. And that is, it keeps you from getting hit in the head with a rock or something, because you say, oh, it's going to stay in this same trajectory. So we have this very mechanistic cause and effect. I can't, fall down unless somebody pushes me down. There has to be an outside force. So they look for an outside force in the stock market. There's constant stock market movement, and there's constant news. And every once in a while, they coincide. They go, oh, see, I told you so.
Yeah.
But it's completely random. There have been, I think, 3. I know I quoted at least 2 very comprehensive studies done by others, and I quoted them in my book, The Socionomic Theory of Finance. And they went in to try to find if the biggest up and down days in the stock market were related to important news. They found they were not. Something like 20% or fewer were actually related to news. 80% of them, there was no news to account for it. And then they also went back with an almanac and newspapers to find all of the days when important news did occur, and to find out if the stock market reacted. And they got virtually the same result. The answer was no. The biggest days in the stock market had nothing to do with news, and the biggest news days had very little to do with big moves in the stock market. It's basically, in my opinion, been proven to be the wrong approach to what's going on.
That's right. People just fit the narrative that whatever they believe, they make the stock market action fit that narrative. So, for example, I remember going back to that example of the 2020 crash, nobody thought the market's going to bounce. I remember reading the comments on social media and on YouTube. Nobody thought the market's going to have a big bounce. We said the market capitulated, that we're expecting a big bounce. Nobody believed it. As the market rallied, then people fit in this narrative, oh, the Federal Reserve, that was the reason. They jumped in on March 23rd, forgetting that the 2 previous occasions the Federal Reserve failed to keep the market dropping.
If it had continued going down, they would say, well, obviously the COVID pandemic is making the market go down further, but it didn't go down further.
That's right.
In fact,
that's right.
It turned up, I think it was the 3rd week of March, very early in the pandemic. It was still killing people worldwide for months and months, and the market was strong. Yeah, so these events have nothing to do with where the market's going. It's an endogenously, or another word, internally regulated pattern of changes in mood, period. Yeah, absolutely.
Let's talk more about it, because in your book, The Socionomic Theory of Finance, you dig into this in much more detail. But for people who are fixated on this idea that it has to be the news and Federal Reserve that makes the market bottom, rally, and all that, what is your view? What I believe is the correct view, your view, as to what's really going on here? Yeah.
Is that the Federal Reserve has no control over the waves of social mood, but waves of social mood have a lot of control over the way people view the Fed. Yeah. So when mood is positive and stock prices are high and the economy is expanding, they say, oh, these Fed chairmen are geniuses. And we had that, Alan Greenspan, and we had And when the markets are a little bit dicey, suddenly people are saying, this chairman doesn't know what he's doing. And of course, they're not doing much of anything anyway. The only thing the Fed can do is print money. Now, we have one chapter. It's very short. Mm-hmm. We checked out about 5 or 6 central banks around the world, U.S. central bank, Australian, And we found the exact same behavior in every single case, which is that the central banks do not set interest rates. What they do is they watch the rate of their short-term government paper. In the U.S., that would be the Treasury bill rates. And if rates are starting to move up by natural movement in the market, then they raise their federal funds rate, and there's an average lag of 5 months. So all this talk about their policy and what they think they're going to do by raising rates or lowering rates, it's just the man behind the curtain. They are simply pretending. They have a meeting and they go, oh, look, T-bill rates are up another 0.5%. I guess we're going to have to raise our Fed funds rate 0.5%. That's all they ever do. So they do not control interest rates at all. And the proof of it is, do you think they'd want to raise rates if they had a choice? Of course they wouldn't. And when rates ran up, they had to follow them. And people said, well, you shouldn't have kept rates at zero for so long. Well, T-bill rates were at zero. So, of course, the Fed's going to follow with their rate as well. So even though I'm not a fan of the Fed, in that case, I would defend them and say it wasn't their fault. They were just following market rates. But the one thing the Fed does do is make up money out of thin air.
Is it correct then that the Federal Reserve is actually the one that is responding to what the market's doing, not the other way around? It's not the market responding to the Fed. It's the Fed being driven by market's actions, and it's responding to it.
Alessio, you hit the nail on the head. You can predict Fed action by watching the stock market better than you can predict the stock market watching Fed action.
Yeah. What do you say to people who, I've seen comments all over on YouTube, they'll say, oh, the market won't crash. How can it? Because the Federal Reserve will just jump in again. They call it the plunge protection team, or I call it the plunge impotence team. But they'll just say, oh, the Fed will jump in and save the day, even though they completely ignore history, as we just looked at it. But in fact, there's a section in your book where you say, you gave an example in 1929, just before the major Wall Street, the bigger depression crash, the bigger 30s crash. You mentioned that there was an article in a Harvard paper where, and I'll put the screenshot for everyone to see. The paper in 1929 said that it's okay, the Federal Reserve will come in, it will save the market from dropping, everything will be fine. Essentially, that's what they were saying. And you said, no, that's naive, that's too simplistic. And that didn't actually happen, as we know, because the market then dropped the market crashed eventually by 80%, 89% from its highs. So what do you say to people who believe in the plunge protection team narrative, that the market will be saved by the Federal Reserve, no bear market, forget it?
You know what? You've already answered the question. You showed that. You showed the chart of 2007, 2009.
Exactly. Yes. Exactly.
If you believe they're going to save you, I'd say good luck.
Good luck.
Yeah.
Yeah. Absolutely. And I'll just finish with there was a section from your book. Okay, I love this quote from your book, Socioeconomic Theory of Finance. And here's what you say: a shocking revelation. What's happening is this. Observers' job, as they see it, is simply to identify which external events caused whatever price changes occur. When news seems to coincide sensibly with market movement, they presume a causal relationship. When news doesn't fit, they attempt to devise a cause and effect structure to make it fit. When they cannot even devise a plausible way to twist the news into justifying market action, they chalk up the market's move to psychology, which means that despite the plethora of news and numerous inventive ways to interpret it, their imaginations aren't prodigious enough to concoct a credible causal story. And essentially, that's the view you have of social mood is what's driving price movement. Social movement.
Yeah, and then most of the analysis you read and coming out of news organizations is exactly that. Whoever's got the pen. So what happened today? What happened today? The market was up big or down big, and then they just it's causal backwards causality. They first look at what happened and then find whatever news fits. The entire standard financial theory is wrong. They, for example, apply economic ideas to financial markets. So they will tell you that the market seeks equilibrium. The market is a process of mean reversion. Now, that kind of thing works in some physical environments and maybe even in certain economic environments, but not in financial markets. Yeah. Markets are relentlessly dynamic. They never achieve equilibrium. They're jumping up and down all at every degree, minute by minute, week by week, year by year. So it's constantly dynamic. Their terminology, the entire structure of standard financial theory is false. And if you take 5 minutes, you can see it's false, but people won't do it. And they declare, for example, that the efficient market hypothesis says that the market is always valuing stocks rationally. Well, they don't really tell us how that happens. And so I looked around and said, well, what are the standards of value? If something is being valued rationally, it has to be valued rationally relative to some standard. So I looked at dividends. You know, dividends have fluctuated 14 times in difference over the last 100 years. There are no standards of value that anyone can point to that the market reverts to ever.
One of the key mistakes which a lot of people make, and I used to make this mistake too, which is that the belief that markets are rational. They have to make common sense, which is why so many people get it wrong over and over again when they try to extrapolate from fundamentals into price action. But you're absolutely right.
Even John Maynard Keynes, who was an economist, said famously, the market can stay irrational longer than you can stay solvent. And you know, he's acting, you know, he was kind of believed in actual valuation and rational valuation, but he said sometimes it goes crazy. Well, what he meant was every now and then we get in a big fifth wave, and it just carries beyond anything that you can try to claim as normal valuation.
Hey guys, Alessio from the future here. I realized when I was editing this video that I forgot to mention the actual reason why the markets bottomed in 2020 and also in the year 2009. As I just explained, the Federal Reserve completely failed to stop the market from crashing here and here. The people who falsely claim that the markets bottomed here because of the Federal Reserve, they're just cherry picking. They're not showing you what actually happened that month. So take a look at this chart. Here is the actual explanation as to why the markets bottomed in 2020 and also in 2009. First of all, at this point, sentiment reached an extreme in fear. In other words, emotions among investors and traders hit rock bottom. You will notice these large gaps on the chart. According to Jason Geppert of Sentiment Trader, these gaps represent a get-me-out mentality. Now, what's a get-me-out mentality? What this means is at this point, investors and traders were thinking, look, I don't care how much I lose, I don't care what the cost is, just get me out of the market. So these large gaps that you see here in the market, these gaps are indicative of extremes in fear. People were watching the news and they were petrified. Also, they were losing money in their broker accounts. And that's why you see these big gaps on this chart. Again, a get me out mentality. Also, take a look at this chart. This shows to you the dumb money sentiment among money managers. As we know, money managers are among the biggest dumb money out there. Notice they went from an extreme in optimism and greed in December of 2019 to extreme fear in March of 2020. At this point, money managers gave up and they exited the market. In fact, March 2020 happens to be one of the lowest readings in sentiment for money managers. So this shows to you what's really going on in the minds of people and investors at the time. As I mentioned, emotion hit rock bottom here. So the first reason why the markets bottomed in March 2020 was, as I said, an extreme in fear and sentiment. But there's another reason, a very important one, which is capitulation. So capitulation is a region of forced selling, which occurred right about here. As you can imagine, when prices are dropping so fast and when people are losing money, often what happens is traders can get margin calls. Margin calls, as I'm sure you know, is when your broker forces you to liquidate and close all your positions unless you can cover your losses. And of course, a lot of people had margin calls and they had no choice but to sell and liquidate their long positions. So that is the second most important reason as to why the markets bottomed in March 2020, because there were no more sellers left. In fact, anyone who could have sold had already sold. So guys, if you think about it, if there are no more sellers left in the market, if there are only buyers, then where's the pressure and the juice is going to come from to keep pushing the market lower? It can't go any lower. As I said, there are no more sellers left. There are only buyers. And that means the only direction that the market can go is up, which is what the market did at that point. So those are the actual reasons why the markets bottomed in 2020, and also the same reason why the markets bottomed in 2009. Thank you very much indeed, Bob. And guys, make sure you do check out Bob Prechter's newsletter, which you can get a great discount if you go to this particular link. That's elliottwave.com/Alessio. Check it out in the description. Thank you very much, Bob. Really appreciate it.